Muni bonds, we're going to go into in a little more depth in a few more slides. The big draw with muni bonds is that the interest that they pay is tax exempt. There have been some issues with munis that we can also talk about. Corporates. Corporate bonds come in basically two varieties, investment grade and high yield. Investment grade corporate bonds are from well-established companies that have a record of strong profits for year after year, and your yields are lower. High yield corporate bonds are also referred to as junk bonds. And with junk bonds, they are from less seasoned companies that don't have a long operating history. They could still be profitable, but they just haven't earned an investment grade credit rating. And so you are compensated with a higher interest rate and a higher yield with less seasoned corporate bonds or the junk variety. There's been a huge rally in corporate bonds and very little value left right now. So I would definitely discourage any new investing in corporate bonds these days. Mortgage-backed securities. This is one area that is still very ripe for the picking. There's been a recovery here also, but with the housing and credit crunch that we had, the mortgage-backed securities market was also taken out to the woodshed and just tar and feather. And so if you are not familiar or do not have any mortgage-backed securities in your portfolio, it can be a very complicated market. So we use an actively managed fund in this area called DoubleLine, and I'll go into that a little later.
And how much percentage-wise in a person's portfolio would you kind of consider as far as a range is concerned?
Well, you have to be careful right now because we've had such a big run-up in so many different asset classes. But this is one area where there's still opportunity. So we're overweighting now, and we've got up to 15% in this area.
15%.
Yeah. Lastly, foreign and emerging market bonds. Our friends at PIMCO in Newport Beach are big on emerging market bonds right now. We are lightening up in that area. Again, it's just like corporates. The prices have gone through the roof. Yields have come down. And there is risk there. There is a lot of risk there at these levels. And so, if you own emerging market bonds, you may, depending on how much is in your portfolio, and again, like 5% is a good target here, but it may be a good time to do some rebalancing, trim some profits off of those, because they are trading at near record high prices today.
Scott,
yes.
Are these considered asset classes? What's the terminology?
No, bonds would be a broad asset class. These are like, kind of like subsectors within the bond asset class.
Okay. But if you're looking for diversification, this is the areas that you need to look at.
As far as your fixed income securities, right. Okay. Definitely. This is a long-term view of bond market performance. Looks at what $1 invested back in 1926 would have grown to in these different areas. The bottom one is the safe treasury bills. That's a 3.6 return, annual return for treasury bills. Muni bonds, 4.3. And remember, that's tax-free. Government bonds over the years have returned 5.5. Corporates, 5.9. And as you would expect, high yield, 6.9. So, some volatility, obviously, with the bonds, the treasury bills. You know, again, it's just a straight line with no risk. Again, the high yield corporates are very rich today, and the same applies to the high yield bonds. As I mentioned earlier with emerging markets, we just sold out of the majority of our high yield bonds in the last couple weeks, and you know, took profits. This is a great chart that again goes back to 1926 and looks at the relationship between bond prices and bond yields. Okay? The orange line on the top is bond prices, and the bottom line, the yellow one, is bond yields. So what we see is that from the mid-20s up until about 1945 or so, the end of World War II, bond prices went up and yields went down. We then, we had a little, basically till about the late 40s, yields stayed really low. Then we entered a 30-year period of rising interest rates. And when interest rates in the market, long-term rates, go up, bond prices come down. So it all culminated in 1980 when Paul Volcker decided to break the back of inflation, raised interest rates, and that started the long bull market in bond prices and brought yields down to current levels. This again, and I think we're in a longer-term bottoming process here, but clearly you can see the risk that exists in bond prices, and this is most pronounced in longer-term maturities, where you see this. Another way to show it would be because this is critical. If you're a bond investor, especially in bond funds, how many in the room own bond funds? Really? Okay. Well, let me illustrate it with just an individual bond. But it applies whether it's an individual bond, a bond fund, an ETF, any bond vehicle, you're gonna experience this. So let's say we're going to put $10,000 into a 10-year U.S. Treasury. So we feel that we like the safety of the U.S. Treasury, and that we think interest rates are going to stay low for a long time. So we can get, we said, how much for a 10-year Treasury right now?
3.19?
Yeah. Okay, so let's say 3.2%. Okay? All right, so that's stamped on the bond. That's our coupon. How often do we get paid that 3.2 annual interest rate with an individual bond? How often does the interest get paid?
Every 6 months.
Every 6 months, semi-annually, correct. All right, so let's say a year from now, the economy has continued to weaken. The Fed has stayed on the sidelines, remained accommodative, and that the government is auctioning these bonds, and they're at like 2.5%. Well, guess what? You have to keep a straight teeter-totter. So your bond with the 3.2 coupon is going to be up here, and it's going to be quoted at around 11,000, or at a premium. All right? On the other hand, let's say inflation gets out of control, the Fed starts raising rate, and so 10-year Treasuries a year from now are at 4.2. Well, if you've got one at a 3.2 coupon, and guess what? And it's got 9 years left till maturity, it's going to be marked down to a discount and going to be worth roughly, say, $9,000. So the point is if market interest rates go up, the prices of existing bonds go down. Okay? Very critical to understand. So how do you get around this? You own shorter maturities, which are less subject to interest rate risk, or you buy individual bonds and hold them till maturity.
What is the average duration in your client's portfolio, or what are you buying out today as far as maximum duration?
Maximum duration, and does everyone know what duration means? It's another word for maturity. It takes into account the cash flows on the bonds. Around 8 is the maximum. Our average, I would say, is closer to the 4 to 5 range at the most. Yeah. So if you go to buy individual bonds, this is what you need to know. Who's the issuer? You know, that's really the most important thing, is your comfort level with the issuer. And because that's your source of repayment. The coupon, again, that's the annual interest rate that's stamped on the face of the bond. Every bond has a maturity date, anywhere from 1 to 30 years. You're going to get higher interest on longer term bonds because you're giving your money up for a longer period of time. The price. Most bonds are issued at par. Okay? With an individual bond, par means a price of 100. Okay? So if you put $10,000 into a bond and it's issued at par, that's a price of 100. All right? If interest rates go up, guess what? This gets marked down. And so, you know, it can drop. So say, you know, then that means it's trading at a discount. Likewise, if you bought bonds within the last few years, you've had a great tailwind at your back. And if you look on your statement now, more than likely your bonds are going to be priced over 100, selling at a premium. Okay? A couple years ago, we picked up some Capital One bonds maturing in 2017. They had a 5 1/4 coupon. We were able to buy them at a discount of 85. So that's $8,500 is what we had to spend for a $10,000 bond. All right, I just sold those earlier this week for a price of $108. So, you know, there are opportunities. There's, you know, they're fairly few and far between today, but, you know, stay alert. And when there's an event, when something happens that causes asset prices to drop, you know, it's our natural tendency is to freeze up and just want to, you know, hold cash. But, you know, when you see a bottoming and any kind of a little turn after a big decline, that's the time to commit capital.
What does yield to maturity mean?
What yield to maturity means is that's really the common factor that you look at in evaluating a bond investment. All right? So if you're buying a bond at less than par, all right, this again, this Capital One bond had a 5 1/4 coupon. Okay? That's your coupon. All right? If you're buying it at 85, your yield to maturity, and again, that's a 2017 maturity, your yield to maturity is going to be higher than the 525 because you've got 15 points of appreciation back to par. Okay? But when you sell it at 108, I mean, you know, the person that bought that from me, you know, what's his yield to maturity? It's like 3.5%. Why? Because it's selling at a premium. So if you buy a bond at par, your yield to maturity equals your coupon.
Is it correctly to state that yield to maturity is the only way you can compare different bonds to as to what you're actually receiving?
Yes, because, you know, a lot of people will focus on the coupons.
But you should be focusing on the yield to maturity.
Well, yeah, because the coupon's important, but then, you know, it's all, what price are you paying? right?
So the only way you can compare one
So
bond to
yield
another
to maturity is the
yield
best
to maturity.
yardstick.
Okay.
Best yardstick to compare,
And
correct.
is that disclosed when you're looking at the price of
Yes.
the bond? That's
Yes.
one of the numbers.
Very
that's
much so.
disclosed.
It's always disclosed.